to 5 Plus Digital TV channel. We are now going to show a video clip of group of friends discussion about S&P 500 index. Please, enjoy the show.
Hello guys, it's been a while since we last met. Let's meet up. When are you guys free?
What about today? I have some plans tomorrow.
I'm so free today.
Yeah, I agree.
Okay, let's meet at the Green Restaurant.
They're now at the Green Restaurant, and having a conversation about their careers.
I have decided to invest into the stock market to make more money than now, but I don't know which stock should I choose. Any idea to help me out?
I will recommend to you to select the stock from S&P 500 Index company because that is the best market index in the US.
S&P 500? What's that?
Okay, sure. Before I explain to you about this index into today, I want to give you a little bit of background information about Standard & Poor's company because that is the provider of the S&P 500 Index.
Standard & Poor? I know it may sound like a stupid question to ask, but what does the word poor mean in here?
You know, in Western country, business often carry the names of the people who started the business, and that is probably the case with Standard & Poor's. S&P was founded when two companies joined together. One company was Poor Publishing Company. The guy who named called Henry Boden Poor started the company in 1860. He published a number of books on the radio, money, and business. He also published financial information about company for investors. In 1906, Luther Lee Blake founded the Standard Statistics Bureau to provide financial information about American company. This company recorded numerical information or statistics about business. In 1916, this company started offering credit rating for company that show a measurement of a person or business entity ability to repay a financial obligation based on their income and their past repayment history.
Credit rating?
Ratings are designed to give an investor an idea how likely a business will pay their debts. Soon after, this company offered credit rating for the whole nation. It later offered the same service for local government as well.
Okay then, how was this company founded?
In 1941, Poor Publishing Company joined with this company to found Standard & Poor's. In 1966, the publishing company McGraw-Hill bought Standard & Poor's company.
What about S&P 500? When does it start?
Okay, then let's talk about this index today. S&P 500 were introduced by Standard & Poor's in 1957 to track the performance of 500 larger companies in the US. The share from that company can trade publicly. Standard & Poor's said that S&P 500 index is the best single measure of United States stock market. Only American companies are on it. They must be financially strong and have a total stock value of more than $4,000 million. The companies are also chosen to represent the importance of industry to the economy.
Interesting. Do you also know about how this 500 company were chosen?
Firstly, the company should be in the United States. A company has to have a market value at least equal to $2 billion. The stock from that company has to be extremely liquid. A minimum 50% of the company outstanding share has to be eligible for public trading. The company have made a profit in most recent period, and the sum of its earnings in the previous 4 quarters must be positive.
Wow, I got some idea why this company is reliable. I want to know more about this company. What else should I know about this company?
I think you should know about the data analyzer of this index because it will help you to know about the performance of the company and you can be able to predict about the future aspect of this company. Before explaining about how to calculate S&P 500 index, I want to tell you how diverse this index is. As we all know, diversification is the key for investing. You know, S&P 500 index fund is fairly diversified. Its investments spread out among 11 sectors, with no sector having more than 30% of many investors. The way of these 11 sectors are chosen based on its growing potential. As the technology industry is the best leading sector in the world right now, it was invested 27.6% of total investment. And 13.5% of the investment go to the healthcare center, and 12.7% to consumer discretionary, and 10.8% to communication service, and 10.4% to financial, 8.4% to industrial, 6.5% to consumer stapler, and 2.8% to utility, and 2.6% to material, and 2.4% to real estate, and 2.3% to energy, respectively.
Great! So who chooses the company in these sectors?
The company from their index are chosen by a committee as Standard & Poor's Company. The committee members meet monthly to discuss changes in the list and choose the company using their criteria, as their goal is to reflect the stock market and overall economy of the U.S. If technology companies represent 20% of the largest company in the U.S., they will make sure their company in their S&P 500 also reflects about 20% technology representation.
How many stocks are there in this index? 500?
By looking at the name, you might think there are only 400 stocks in the index. Actually, the index contains 505 stocks because some companies have dual-class system.
Dual-class share system?
Dual-class system means having Class A share, which are more voting right, and Class B share, which are less voting right.
And how does S&P 500 index calculated?
The S&P 500 index is calculated by using the free float market capitalization method. It is a method of calculating market capitalization of the index. In this method, the larger market capitalization a company has, the greater influence on the index price performance. For example, if Apple is the largest company in their index, the value change in Apple stock will affect more on their index than any other company in their index. The formula of S&P 500 index calculation is the total market capitalization of all companies in their index divided by the price. Market cap of a company is calculated by current share price into number of outstanding shares that are actively traded in the market, which means it excludes the shares that are held by executive and insider or promoter and government. The S&P company doesn't necessarily share the value of the divisor as well.
Does S&P 500 index stay stable all the time?
Well, the S&P index is changing all the time. Whenever the company in the list issue more share, or split the share, or the stock price change, or the new company is replaced by an old one whose stock price falls solo. Okay, my mouth is hardening by talking too much. If you have more questions, ask Ting.
Okay, I can explain to you about the historical and current performance of S&P 500.
I want to know about historical performance first. How was it back then?
The S&P 500 index originally began in 1926 as the composite index comprised of only 90 stocks. According to the historical record, the average annual return since its establishment in 1926 through 2018 is approximately 10% to 11%. The average annual return since adopting 500 stock into the index in 1957 through 2018 is roughly 8%. In 1957 to 1967, the S&P 500 index reached nearly 700 points within its first decade, representing the post-World War II economic boom. Then in 1969 to 1981, the index steadily fell below 300 as the U.S. economy struggled with slower growth and high inflation. In 2007 to 2009, the S&P 500 dropped 57.7% during the financial crisis that became known as the Great Recession. In 2013, the S&P 500 had recovered all of its losses from the financial crisis. Look at the graph here. You can see they are down in return, but at the majority of the time, the return are up. So for the long-term investment, your return will be positive.
Does this return compensate against the inflation? You know, inflation rates are going up these days.
Okay, after adjusting the inflation, the historical average annual return is around 7%, which is not that bad.
Then I want to know why S&P 500 index is very popular.
Yes, I can explain you. Investors are holding S&P 500 index fund, trying to match the performance of the index, not to outperform it, so that they can use the buy and hold strategy of the investment, also we known as the passive management. There is no need to actively monitor the stock market movement and engage in the instant intraday trading. Even the inexperienced investor can earn high return by investing in the index fund. And then, since the index fund represent all the sector of the US stock market, they are diversifying investment with relatively low market risks. And then the high number of constituents of the S&P 500 future reduce exposure to the market risks.
Can you explain more about the advantage of S&P 500 index?
So, what are the advantages of S&P 500 index? That an index fund is a collection of stock or bonds that mirror a certain stock market index, like the S&P 500 or the Dow Jones Industrial Average. And then the S&P 500 index fund tracks the S&P 500, and it includes stock from all 500 companies within that index. S&P 500 index fund generate long-term positive return. The S&P 500 itself is one of the best representation of the stock market as a whole. While the market has experienced volatility over the year, it always managed to recover from downturns, corrections, and crashes. The S&P 500 index funds are that likely to eventually recover when the market takes a turn for the worse. In addition, S&P 500 index funds are perfect for hand-off investors. When you invest in this type of funds, you are instantly investing in hundreds of stocks at once. You don't need to research which stock you are investing in or worry about whether you should buy or sell particular investment. The fund takes care of all of that for you. Finally, because index funds are long-term investment, they work best when you leave them alone for as long as possible. All you have to do is invest your money, sit back, and let the funds do everything else. I hope you understand when you invest the S&P 500, what are the advantages you will get it.
Oh, you sound so great. Are there any famous financial analysts or research institutions that made a review or analysis about S&P 500?
Of course, there are many financial analysts and advisors who advocate and recommend the investor to invest in S&P 500 and point out its limitations. Have you ever heard about a man named Warren Buffett?
No, I haven't heard about him.
You know, Warren Buffett is considered one of the most successful investors in the world, who is the chairman and CEO of Berkshire Hathaway, who is also the world's fourth wealthiest person. He explained that S&P 500 low-cost index fund is what he picked for the average investor.
Why did he pick S&P 500 and what do you mean by low-cost index fund?
He advised the average investor to buy the S&P 500 index fund over a long period of time because it is the low-cost index fund which has low operating expenses and it can provide broad market exposure. He imagined a low-cost index fund is the most reasonable equity investment for the great majority of investors. Buffett told in his book, The Little Book of Common Sense Investing, he advised people that by periodically investing in an index fund, the know-nothing investor like you can actually perform better than the most investment professional. And you know, there is one company, Motilal Oswal Financial Service Company in India. They made a review of whether the S&P 500 is suitable for Indian. Motilal Oswal Asset Management Company is launching an index fund that track S&P 500. A large number of companies that operate in India are part of S&P 500. These include Amazon, the Coca-Cola Company, McDonald's Corporation. That company made a review of whether the S&P 500 is suitable for Indians or not. There, they compare S&P 500 with Nifty 50.
Nifty 50?
Yeah, Nifty 50 is a benchmark for Indian stock market index that represents the weighted average of 50 of the largest Indian companies listed on the National Stock Exchange.
What are they explaining in the review?
Oh, they explain that Nifty 50 is India's loosely diversified index compared to the S&P 500, which is America's highly diversified index. The approximate compound annual growth rate (CAGR) of 5 years in Nifty 50 is 8.2% and S&P 500 is 12.7%. The approximate 10-year return is 8.9% CAGR in the Nifty 50 and 12% CAGR in S&P 500. Clearly, S&P 500 has performed better than Nifty 50 2 to 3% in the past years. In the review, they described S&P 500 advantage better than Nifty 50 is dollar hedge and global exposure, which is diversification. They comment that there is no significant risk in S&P 500 but only opportunity risk. That means if we buy S&P 500 and if India economy is strengthened, then we have not lost money but only opportunity to participate in India growth.
What did they suggest or recommend in the end?
In the review, finally suggests that the economy is wide and India is like small cap company, which is smaller in size and has a long way to go, whereas America is somewhere between mid cap and large cap, and both have pros and cons. They suggest that whether we end from India or America, small cap or large cap, as long as we earn sufficient good interest, nothing matters.
That sounds good. I think I really need to go for S&P 500 index to invest after hearing all of your opinion.
Oh wait, there are also some limitations or disadvantages of using S&P 500 as a benchmark that you need to keep in mind before you go investing.
You're right. I totally forgot about that. Tell me, what are they?
Don't worry, not much. The first limitation is S&P 500 index contain only larger market cap company from the United States, but investors may own small cap or foreign company in their portfolio. Therefore, using S&P 500 as a benchmark can be an inaccurate measure of portfolio return for individual investors. Another problem using S&P 500 for benchmark purpose is that the index is disproportionately weighted toward larger companies, meaning the top 50 companies with higher market cap have a larger impact on the calculation of the index and account for more than half of the index value. That result, the increase and decrease of price in the larger company have an excessive influence on the overall index. Therefore, just by looking at the overall performance of S&P 500 can be misleading at times.
Alright, now I know about its limitation, background, and performance, but still I'm worried about whether this is a good time to invest in the stock market. I mean, COVID-19 is a recent case and it's still going on, right? Also, I have the stock market has suffered a lot due to the pandemic. So, should I invest now in the S&P 500, and is S&P 500 recovery now, or what are the future prospects of S&P 500?
Yeah, since 2020 is a rough year for the entire globe because of the impact of coronavirus, both the stock market and economy suffer a lot. But in 2021, the pandemic is already showing signs of decreasing and recovering, and this will mean a return to strength for the S&P 500. Then Wall Street analysts who are forecasting the year-end 2021 earnings per share and price target for every stock in the S&P 500 see the market index rising to 4,000 level. Also, the knowledge that the economy and the market will recover is almost universally felt. Some analysts say this is the perfect time for traders to enter the market and take advantage of the probable increase in the coming months. In terms of price target, Bank of America is targeting S&P 500 from 4,100 to 4,500 by 2030, between 47% and 61% overall increase over the next 10 years.
So S&P 500 index is reliable, affordable, diversified, liquefied, and its return is also pretty stable. The famous investor like Mr. Buffett also recommend it. So I think it is perfect for a beginner and average investor like me who doesn't know much about the stock market. And thank you guys for answering all of my questions. Put your wallet away. This lunch is on me.